Have you ever seen an investing app advertisement? That's kind of a rhetorical question. I already know you did, probably more than once on more than one website. That's normal nowadays. Investing is becoming more and more common every day, and we usually see two types of investors: Forex investors and stock investors. What is Forex investing, and what are stocks? What are the key differences, and which one should you pick? In this video, I'm going to give you all the information that you need to not only understand what the Forex and stocks are, but to also have the basic knowledge that will give you a better understanding of which one you should choose for your next investment. First, I'm going to explain to you what stocks are. What are stocks, and how does the investment work? Stocks are very simple to understand, but many brokers and institutions always complicate the topic in order to get people to work with them. While working with a broker can turn out positively, knowing the basics is fundamental for a healthy investment. A stock, or share, is basically a part of a company that you are able to buy in order to help that company raise the necessary money for investment. As soon as you buy a percentage of the company, you're the owner of that part of the company, and you have the right to receive the equivalent percentage of what you invested when the company makes a profit. Still not clear? Let's take an example to make things simple. Imagine Frank started his own company. He always wanted to sell shoes. He's a master in creating wonderful luxury shoes, and he wants to build his business around his skills. In order to start his business, he needs $1 million. This money will be used to hire the staff, pay taxes, create and customize his shop, and fund his business. But there's a problem. Frank only has $100,000 to invest in his business, so what should he do? He takes his company public, telling potential investors how good his company will be, and trying to sell them on his idea and vision. If investors believe in his business and that it has a decent probability of making a profit, they invest in Frank's business, in hope of a financial return when the company is successful. Let's pretend that Frank convinces 9 of his friends to invest in his company. And you are one of these investors. Each and every one of them invest $100,000, helping Frank reach the needed money to start his business. According to simple math, $100,000 is the equivalent of 10% out of $1 million. Since every person invested 10%, every person owns 10% of that company. Now, Frank has $1 million to start his business, and so he does. He called it coolest shoes around, bro. He starts producing his first shoes. He sells them, then he hires more and more people that help him produce and sell more. That keeps happening until 1 year has passed since the foundation of coolest shoes around, bro, and the company is worth $10 million. So you are the owner of 10% of the company. So now you have $1 million, the equivalent of 10% out of 10 million, the current worth of the whole company. Also, every other investor has $1 million. And that's it. Simple, right? Obviously, this is an absurd example with absurd numbers, but you get the point. So, when you invest in stocks, you look for companies that have potential and you believe will grow in the future. In this example, I described the case of buying to hold, meaning that you buy stocks with the intention of holding them for a long period of time. But this is not the only way to invest in stocks, so keep watching. There's also speculation that's used in Forex trading. Speculation is to buy shares when they're undervalued, wait for the price to rise, and then sell the shares in order to make a profit. For example, you might buy a stock worth $10 today and sell it tomorrow when it'll be worth $15 and make a profit of $5. So with this being said, you need to know that investing is incredibly risky. No amount of calculation can for sure predict the future. No one knows for sure if the stock will go up or down, no matter how qualified and how much experience they have. So you might lose a lot of money, but you can reduce that risk if you only take calculated risks. Stock prices fluctuate up and down very fast, and the market can be drastically changed in a matter of seconds. Warren Buffett is one of the greatest investors of our time, and his advice is to always invest in companies that have potential and to think long-term. So, calculated risk is the key to a good investment. Now that you know how the stock market works, let's talk about Forex. How does Forex trading work? Trading Forex is pretty similar to trading stocks with speculation. So you buy low and you sell high. The first key difference is that you're not buying and selling the ownership of a part of a company. You're actually trading currencies. Just like stocks, the value of currencies go up and down every single day. For example, the value of €1 is currently 1.14 US dollars. That means that the exchange rate of the euro versus the US dollar is 1.14. When you invest in currencies, you basically convert your money to another currency, in this case, the euro. You forecast that the euro will rise versus the dollar value, and you are correct. Later that day, the euro rises to 1.15, and being in the profit, you decide to close the trade and convert your money back to US dollars, having more than you had before. If, however, your prediction is wrong and the euro falls against the dollar, you will lose your money and you won't be able to close the trade until you either go back into profit or lose all your money. Now, Forex is actually harder to predict, making Forex, or FX trading, riskier than the stock market. A currency can gain or lose value very rapidly, and there are advanced ways to increase profit, but also risk, that we aren't going to cover in this video. However, if you understand this basic principle of Forex investing, you're already a step ahead of most people. Forex is heavily advertised, so it's really common for new investors to start with this type of investment. I even received Instagram DMs from people that were trying to talk me into investing with them, so that's a common practice too. So now, you know how foreign currency investing and stock investing work. Now, let's talk about the main differences that will help you choose between one or the other. Regulation. The first difference is the regulation that the two have. On one hand, the stock market is heavily regulated by institutions like the SEC, Securities and Exchange Commission. Everything is controlled by these institutions. So it's fair to say that it's a bit harder to be scammed if you're investing in stock. However, the risk of losing money is still there if you take the wrong decisions. On the other hand, FX trading isn't as regulated. In fact, there isn't much regulation at all, except for the BIS, which is basically the bank of all banks. However, regulations are very light, so there's a higher risk of being scammed by those insta-traders. Forex is called OTC trading. OTC stands for over-the-counter. It's also called off-exchange trading. This means that the trading is made directly between the two parties, without supervision. So, a stock exchange is opposed to Forex because it's more transparent and regulated. Let's go over the next difference. Short versus long-term investment. Another key difference is the time needed to make a decent profit with an exchange. Forex is bought and sold daily. So, you buy it today and sell it later. Or you buy today and wait some days or a few weeks. In some rare cases, even 3 to 6 months. However, there's no sense in holding on to an exchange for too long. Are you with me so far? Now, shares are usually profitable when intended for long-term investments. This means that you buy shares today and wait for the market or the business to develop. You can even hold on to some shares for a decade and then sell them and make millions with them. So, at first glance, you'd say that Forex is better because you can make more money faster, but that's only if things actually go well. As I said before, it depends on whether you make the right decision or not. The next and last difference is market purpose. The market purpose of shares is actually usually different than the ones that I explained to you earlier. Many people actually put their money in the bank, and from there, they invest in stuff like mutual funds. That's a small investment that makes very little profit. However, many people do it, and that's a huge factor when it comes to making decisions. Also, the stock market is very value-oriented, so when you actually invest to hold on to a share or to speculate, you do consider the value of the company you're investing in, trying to understand if it will be a success or not. On the other hand, the purpose of Forex is basically limited to speculation. That's it. You aren't supposed to hold these trades long-term. You just buy, wait for the value to raise, and close the trade. It's very simple. So do consider these very important factors when choosing between the Forex and stock market. That's it. What do you think? Will you start investing soon? If so, do you prefer investing in stocks or do you trade currencies? Also, if there's someone out there that has the experience, share your knowledge in the comments below. Who knows, you might help someone make profit in their next investment. If you like this video, please do click the like button and subscribe to this channel now in order to stay up to date on the best investment strategies and advice on business, finance, entrepreneurship, mindset, and much more. Also, we have another video on investing. You can find it in the description down below. Well, thanks for watching. Have a great day, and I'll see you in the next one.